guys. Hey, thanks for coming out this morning. We are on a cruise, so this should be fun. Alright, I hope everybody can see that. I know now it's getting bright. I actually like the fact that it was early in the morning and it was kind of dark. I'm gonna go ahead and start. I have a lot to cover. We got a couple of little tiny videos, and I think most of you are familiar with my work. I'm on YouTube. You can just Google me, Vays. Spent about 10 years on Wall Street. I mostly used to trade. Now I kind of travel and try to explain Bitcoin and blockchain. And I was watching the whole ICO from Ethereum's introduction to Ethereum's crowd sale to all the ICOs being built on Ethereum. And from the very beginning, a lot of things didn't make sense to me, and a lot of things reminded me of what I saw during the dot-com bubble. I wasn't really old enough to participate in the dot-com bubble. I was still, studying in my university. But I remember what happened then, and I learned trading from people that survived the dot-com bubble. So over the last year, I've seen so many similarities between the ICO bubble and the dot-com bubble, and I wanted to put together a presentation just for that. So I'm not going to talk about myself much. You guys can always go ahead and Google me. But about a year ago, I had to change my LinkedIn summary because everyone was hitting me up to be an advisor for their ICO. So I actually changed LinkedIn summary. I know you can't read it, but I kind of have it already memorized, saying, I am not interested in your ICO or token sale. Please send all requests to Vitalik Buterin, who is responsible for this nonsense. That's pretty much what I changed my description to, because everyone needs advisors. And this presentation will focus on ICOs, but it's going to talk about the dot-com bubble itself. Those that remember the dot-com bubble, the price of the NASDAQ went all the way to 5,000 points on the NASDAQ. But the craziest thing is, right, when the NASDAQ finally crashed and bottomed in 2003, it took 15 years for the total market cap of the NASDAQ stocks to get back to new all-time highs. Think about that, right? The NASDAQ, the bubble, the height of the internet was in 2000. The next time the financial value of all the companies on top of the internet made a new high was 2015. It took 15 years for the valuation to come back up. And that's what happens in a bubble. But what happened to the internet itself during those 15 years? Do you think at any point less people started using the internet? No, of course not. More and more people were using the internet, but the valuation of those companies got too high, and it had to correct itself until it finally made a new high in 2015. So now, let's zoom in on that and actually look at the anatomy of the dot-com bubble. And we'll start off back in around 1996. So in 1996, one of the first biggest companies went public. Right around the time Alan Greenspan named the term irrational exuberance in reference to the dot-com bubble, saying that prices are getting a little out of control. The first big company to go public was Yahoo. So Yahoo, when it went public, on the first IPO day, Yahoo went up in price 50%, and the stock closed that day at 33. That means the stock opened at 15, where the VC and angel investors were able to exit in the IPO market, and the general public bought up that stock on the first day, and the stock went up 50%, closing at $33. When you split adjust that, that's only about $1.33. Things moved on from there. Amazon went IPO in 1997. Amazon was much better priced, and Amazon only went up 31% on its IPO day. So Amazon IPOs goes up 31%, it goes to $23 on the first day, and that's approximately $1.50 in today's terms. So if you are a retail investor, you could have bought Amazon for $1.50. And right now, Amazon is trading at, I believe, just under $2,000 a share, okay? So as a retail investor. So we're gonna get back to that concept. Retail investors versus angel investors versus qualified investors, okay? Then things started to get a little bit out of control, starting with a company called theglobe.com. Actually, I jumped one slide too far. Theglobe.com was an IPO that set a new record. The day the company IPO'd, the stock went up 606%. The stock closed that day at $63. So what was theglobe.com, if anyone remembers? Theglobe.com was basically, you would have like your own internet. Like it would be, it was a website, and you would have like your own world, like your own World of Warcraft, basically. Like you would be your own world on the internet. That stock traded at like $100 a share on its opening day. It closed that day at $63 a share, and it was still up 600%. The initial valuation was only $6, and the early investors got to exit at between $60 and $90 that day. So the founders of that company became instant multimillionaires. Some of them were worth $100 million. Their web developers became worth $10 million plus each. That was the Globe.com. The Globe.com's record for the opening IPO return was succeeded by VA Linux. VA Linux was basically Dell for your Linux platform, right? So it was a computer that would run Linux, and they would custom make those computers for you. So that stock broke the record. It closed the day at 700% up above the initial opening IPO price. The first trade on the first day of trading to the retail investors was at $300 a share. And if you look at it, you can't really see the chart. The first trade was at $300 a share, and it continued to fall for the next 2 years until the stock was eventually delisted when it started trading below $3. So it went from 300 all the way to 3 until the company had to file bankruptcy. Here's one that I actually remember because us as college students certainly participated. These were some of the brightest ideas coming out of the dot-com space. Anybody remember Cyber Rebate? That was in the late 90s. So Cyber Rebate would sell you things like, I'm trying to remember what was popular back then. Maybe, I don't think this was like before digital cameras, but they would sell you like a Discman, right? Or like a CD player. But the CD player is worth like $20 or $30. So they would sell it to you at 10x the price. So they would sell you like a $300 CD player. And then you can file for a rebate for the full value of the CD player. So you're buying a $200 CD player, you file the right paperwork, and they'll send you the entire $200 back. So that was the genius business model that most of the people will be too lazy to file their rebates, and the company's gonna make a lot of money. At the end of the day, the company blew through about $30 million in capital, and they owed, I think about 10 people over $100,000 each in those rebates. And people ended up getting paid 8 cents on the dollar. So that company didn't really work out very well. So there's gonna be lots of examples of crazy things that happened during the dot-com, but it's all about the exit, right? There was a notable buyout. AOL buys Time Warner for $156 billion. AOL, anyone know, does AOL even still exist? And they had $156 billion to buy Time Warner Cable. And being able to properly succeed in a dot-com bubble is really all about getting out at the top. So let's talk about a company where someone got out at the top. If anyone remembers Broadcast.com, and prior to Broadcast.com, it was AudioNet. Basically, there was a little company that really interested a gentleman by the name of Mark Cuban. And Mark Cuban really wanted to listen to his Indiana college basketball games on the internet. So he had his goal of putting internet, radio on the internet for the purposes of listening to basketball games. So he invested $10,000 into this little company. They changed the name to AudioNet, and they started doing their venture. So he was able to convince the founder of that company to let him be the CEO because he had a better vision and would have been able to do a lot of great things with the company. So his $10,000 investment, they changed the name to Broadcast.com just before they went public. When the company went public, Mark Cuban was worth $300 million off of Broadcast.com going IPO. 9 months after going IPO, Yahoo bought them out. I forgot the number, but Yahoo bought them out, valuing each listener to Broadcast.com at $10,000 a person. When Yahoo bought them out for, I think, $10 billion or something, that made Mark Cuban a billionaire, and he cashed out all the Yahoo stock they paid him, and Yahoo delisted and removed Broadcast.com within 2 years. So within 2 years, Broadcast.com no longer existed, but Mark Cuban was able to cash out over $1 billion from that company. Okay, so that's about getting out at the top. If you go to Wikipedia, you'll see a list of about 100 notable, interesting companies during the 78% correction of the NASDAQ bubble. There were a couple of other interesting things that were taking place during that time. One of them was the fact that companies would simply change their name to be something involving the internet, and all of a sudden they would see their stock price go up. One example is eDigital. So when eDigital changed the name, the stock basically went from a couple of cents all the way to like $40-something, and the SEC did not look kindly to that. And we've already seen similar things in the crypto space. The SEC came down on a company, Syad, where they were a penny stock, and they announced they were going to do an ICO, and the price of that stock went from like 2 cents to like $1, and then the SEC got involved quickly. Here's a better example. The Long Island iced tea company changed their name to the Long Island blockchain. So what happened with the stock? Oh, I thought we were charging. Hey guys, do you mind plugging that back in? So once they changed the name to the Long Island iced tea company, changed it to the Long Island blockchain, their stock went from about less than $1, went all the way to $16 that morning. And there was a very good quote in the Bloomberg article, and that quote basically read, so it's very reminiscent of the dot-com days, like when during the dot-com days companies would simply change their name and they would see their stock go up significantly. Hey guys, I think you're gonna need my login to get back into the computer. I'll be right back. All right, we're back. Ooh, focus. I just click on the other screen. Just click on the other screen. So I have. Yep. Sweet. I got it. Cool. So here's an example everybody would know. This is pets.com. Everybody remembers pets.com, right? Now, pets.com is actually a really good example of qualified investors versus unqualified investors. And you hear a lot about, well, how come only the rich get to get richer by being able to invest early in companies? In reality, nobody knows which company is going to succeed. And this is why the definition of a qualified investor is someone that actually has the money to lose. Because most investors will not, they just don't know which company is going to succeed or not. Let's take Pets.com, for example. Most people don't know who the biggest investor was in Pets.com before Pets.com went public. The biggest investor was actually Amazon. So even Amazon didn't know who was going to win the retail game. There's really no difference between Pets.com and Amazon. One started selling books and the other started selling pet supplies. Amazon had like a 45% stake in Pets.com when Pets.com went public. And Pets.com did not exactly work out very well. So that's the big difference. So when you hear all these people trying to tell you, hey, the rich got richer by investing in Facebook early, you should have a chance to invest in Facebook early. Here's the reality of the situation. Almost everybody would have had their money in MySpace. Very few people would have had their money in Facebook. There was MySpace, there was Friendster, there was Women, there was High Five. There were like a dozen other social networking companies before Facebook. How do you expect the retail investor to know which one it is and to take that risk? That's what everybody will tell you. In reality, Facebook went IPO at $40 a share. It was overpriced. Within a few weeks, it was at $20 a share. No one stopped you from buying Facebook at $20 a share. Within 10 years, you would have made 10 extra money. I know it's not the ICO, the altcoin space, where you can make 1,000 extra money in a few weeks, but those days are going to end. In reality, most people do not have the capacity to pick winners and losers. The VCs themselves, for a VC, it's their job to pick out winners and losers. And you know what? They barely get it right. On a 10-year scale, you'll probably make more money putting it in the stock market than you will with a VC. And that's in a traditional space. That's why there is this separation between retail investors and qualified investors, because they have the money to lose. So lots of other things took place during the dot-com bubble. Here is one of them. If you guys think that the attempt to make Bitcoin is new, it's not. Let's see if we can play this video. Hit the play button, guys. I hit play.
Because you're all old, honey. Give them flows, online gift cards. It's just like fun. You send it by email, they spend it at some of the web school stores, and you come out hip and smart. Congratulations, baby. Duh.
So Flues was actually around 97, 98, and Flues was going to be money on the internet. Flues was an attempt to make money on the internet. Whoopi Goldberg was promoting it. This was a commercial during the Super Bowl back in the late 90s. And let's see what happened to Flues. So basically, the FBI eventually came down on Flues because the majority of the people that were using Flues internet money were basically for money laundering and to steal credit card accounts and to convert them into internet money. And this is the problem. The fact is, all of these initiatives to put money on the internet before Bitcoin were centralized. And when your initiative is centralized, the authorities can easily come and take care of that, take care of it because you are centralized. This is what separates Bitcoin from all the other cryptocurrencies. And those that are doing ICOs have to realize that they think they're doing something decentralized, but they're not. If you are a company, if you have a CEO, if you have public people, and you're trying to do something innovative, but it's not decentralized, you are at risk. Now, I'm not saying that's a good thing, I'm just saying that's a reality of the situation, okay? So everything that's happening now has been attempted before. We just have slightly better technology now. Here's another interesting example. When you start Googling some of the more interesting things that happened during the dot-com bubble, here's an example. Somebody wrote out of San Francisco. There was a guy that wanted to do something really cool in communications, came up with some crazy idea, created a really cool website, and spent a bunch of money putting together a giant billboard in San Francisco announcing his project. That caught interest of a publicly traded company, and they bought out him and his idea for $100 million. They gave him a contract. He has to stay there for 3 years in order to integrate his idea. After about 3 months, the company realized that he was kind of useless. So they said, hey, take your $100 million and go. He left and then realized, wait a minute, I didn't really have that good of an idea, and these guys have no idea what they're doing. So he used that money to short the company and pretty much ended up doubling his money because that company absolutely collapsed. And reading that story about a billboard, I know you guys can't see the screen, but if any of you were at Consensus last year, there were these giant billboards of EOS all over Times Square. And that totally reminded me of that story. So let's see how EOS is actually going to end. All right, so those were all the crazy things that were happening, and a couple of really good movies were made from that. How many of you have seen Wolf of Wall Street? Perfect. And here is the thing. So I'm going to play one clip from the movie Wolf of Wall Street. Most people don't know what exactly did Jordan Belfort go to prison for. So go ahead and listen, because he explains it in this 30-second clip.
An IPO is an initial public offering. It's the first time a stock is offered for sale to the general population. Now, as the firm taking the company public, we set the initial sales price and sold those shares right back to our friends. I know you're not following what I'm saying anyway, right? That's okay, that doesn't matter. The real question is this: was all this legal? Absolutely fucking not. But we were making more money than we knew what to do with.
You heard it right there. A lot of people are complaining that the reason you need to go ICO is because it's so difficult to go IPO. A lot of regulation, it's very, very expensive. And this is why. Because when Jordan Belfort and his company had the ability to take companies public, what they were doing was they were setting the initial sales price and they were giving preferential treatment to their friends to buy into those IPOs before those IPOs went public. And again, think about what is happening in the ICO space, right? You do the there's a pre-ICO, then there's a pre-ICO, right? So the connected people, the insider people, they're getting those shares first, and then they're selling them to you on the open market once it goes to on one of the exchanges like Binance or Bittrex, right? And that was it. So if you next time you rewatch the movie Wolf of Wall Street, just keep an eye on the fact that that is exactly what they were doing. They were giving preferential treatment to the insiders before they went IPO. And other notable people got in a lot of trouble for that. This guy, for example, took companies like Amazon public, and then there was a big case out of New York that, let's see, what companies? Netscape, Amazon, and a couple of others. Again, preferential treatment. I know you guys don't like Wall Street, you think they're all crooks, but this is the kind of thing that they attempt to weed out, the giving of securities before they go public in a preferential way. So that was pretty much the history. I'm going to be wrapping up this presentation. So what happened was the valuation fell in about a year and a half, but it took, like I said, it wasn't until 2015 until the overall value of the NASDAQ went back all the way up. And I remember a couple of stories. Like I said, I was in my university back when the dot-com bubble was happening. I remember one of my dorm mates at the time basically borrowed, he was like 18, 19 like I was, borrowed $1,000 from his older brother and was like in his room trading penny stocks. And I wasn't a finance major back then, And I remember that that seemed very, very interesting to me at the time. And now, as I reflect, what helped drive the dot-com bubble? And my conclusion recently was, wait a minute, it was online brokers. If anyone's seen the movie Boiler Room took place before the mid-90s. So before the mid-90s, before there was E-Trade and Scottrade and all of these Ameritrade, and what was the E-Trade baby commercials from the 90s. Before that, you had these boiler rooms where people had to cold call people that had money. You had to call doctors and lawyers and accountants. You had to call middle class and above to try and get them to give you money to invest with you. But in the late 90s, what happens is now you have online brokers. So now the taxi driver, the shoe salesman, everybody, your barber, they can trade from their own home. All they need is a computer, but they need a little bit more than that, right? You remember the stories when your taxi driver starts telling you about the latest IPO, it's time to get out of the market. But why did that happen? How did the taxi driver have access to trade? And that was E-Trade. Because now you can do it from home. However, there was still barriers to entry. You still needed a bank account. You still needed to be a resident of a specific country. And if you wanted to be a day trader, you still needed $25,000. That's the 3-day rule on a settlement, okay? So there were some restrictions, and all those restrictions are now gone. So is it possible that the ICO bubble has not popped and is only gonna go back to the upside? The answer is yes, because now it's global. There is no geographical restriction. There is no financial restriction. You have $20 to your name, you have $1,000 to your name, go ahead and trade. And here's the best one. There is no age restriction, unlike there was in the 90s when you had to be 18 and have a bank account. So here's what happens when you don't have an age restriction. Here's an email from my inbox. Dear Mr. Vays, I am 15 and a half years old and in high school, and it's a whole email asking me for trading advice and when to buy and sell Bitcoin. Here's a, oh wait, and there's a better one right there in the corner. That's actually a 13-year-old, same thing, talking to me about an ICO. Now again, I don't know they're 13 until they just feel like saying it, right? Because random people end up messaging you. So there's no age restriction. So this really is like the dot-com mania on steroids, because you get this new wave of people that have never traded before, that have never speculated before, and they think this is something new that hasn't existed, when in reality, it pretty much repeats every 20 years or so with every generation. Here's a couple of really good tweets by Alex Marco, so I wanted to throw them in the presentation. Here's one big difference between traditional startup funding and ICOs. Founders of failed startups shouldn't come away financially enriched. He followed it. Risk capital to explore ideas is great, but incentives aren't aligned if founders' money at expense of investors, regardless of outcomes. I followed that up as well, basically trying to explain that Bitcoin is actually decentralized, when the rest pretty much isn't. So I'm gonna, how much time do I have left? Like maybe 15 minutes? I'm gonna assume 15 minutes, okay. So I have one more video to play. This video is about 11 minutes long, and then if there's time, I'll take a couple of questions. Normally on my YouTube channel, we talk more about the price of Bitcoin, but I really like this presentation about the dot-com bubble versus the current ICO bubble, because there's just so many similarities. So recently I was at another conference, and there was a gentleman speaking about the insurance industry. It had nothing to do with Bitcoin, had nothing to do with cryptocurrencies, but he played a clip from a documentary that was really good, and I went back and I watched the documentary. It kind of explains how these things happen. So this documentary is called Dishonesty, the Truth About Lies. And it's how people end up in this groupthink, thinking that everything is okay, and they don't realize that they could be doing something unethical. And this documentary is really good, and it talks about some of the reasons how that happens, and people don't really think they're doing anything bad. So in this clip, there's one section about tokens. And if you can see the video, they actually flash Bitcoin. And this video is from like 2013. It was just, happens to be there. So pay attention to a part that says distance from money. Let's play it, guys.
And I'm interested in human behavior. I'm interested in rationality and irrationality. I'm interested in the cases in which we make good decisions and the cases in which we make bad decisions. And in the last few years, we've been focusing on dishonesty. We watch corporate scandals everywhere. Enron, WorldCom, the financial crisis of 2008. We saw an increase in cheating in professional sport, witnessed political deception and its huge repercussions.
Does the NSA collect any type of data at all on millions or hundreds of millions of Americans? No, sir.
On one hand, we want to look at the mirror and think that we're good, honest, wonderful people. On the other hand, we want to benefit selfishly from being dishonest. As long as we choose just a little bit, we don't have to pay any price in terms of the image and the way we view ourselves. And we call this the fudge factor. So this is the ability to misbehave and think of ourselves as good people. And you can think about all kinds of ways in which in your own life you have a fudge factor. The speed limit. Maybe it says 55, but are you okay in driving 60? What about cheating a little bit on taxes? What about exaggerating their online dating profile? Across many studies, we find that everything that changes the fudge factor also changes people's ability to be dishonest. There are dozens of elements that can change the magnitude of the fudge factor. And we've been able to observe many of them in the lab. For example, if you can say to yourself, everybody is doing it, it's easier for you to rationalize to yourself that this is actually an okay thing to do and cheat to a higher degree. To study dishonesty, we need to be able to measure, hopefully precisely, the extent to which people are dishonest. So we have all kinds of methods. I'll describe one of them.
You can just have a seat anywhere with a packet and a pen in front of it.
We gave people 20 simple math problems.
Find the two numbers that add up to 10.
These are problems that everybody could solve if they had enough time, but we don't give people enough time.
We are going to give you 5 minutes to solve as many as possible.
At the end of the 5 minutes, please stop, put your pencil down and count how many questions you got correct. And now that you know how many questions you got correctly, take the sheet of paper, go to the front of the room, and shred it. People do that, they come to the front, they say they solved 6 problems, paid them $6, they go home. What the people in the experiment don't know is that we played with the shredder. The shredder shred the size of the page, but the body of the page remains intact. And what do we find? On average, people solve 4 problems and report to be solving 6.
I solved 6. I don't know if this is embarrassing or not, but I got 6.
I believe I got 7 right.
We've run these experiments on 40,000 people. And so far we found about 20 big cheaters. Those are people who cheated all the way, said they solved 20 problems, and they stole $400 from us. And we also found about 20-some thousand little cheaters, and they stole about $50,000 from us. And I think this is not a bad reflection of reality. Yes, there are some big cheaters out there, but they are very rare. And because of that, their overall economic impact is relatively low. On the other hand, we have a ton of little cheaters. And because there are so many of us, the economic impact of small cheating is actually incredibly high.
In one project, Dan and I decided to look at what's the influence of others' unethical behavior on our own decisions to cheat. So we designed an experiment with different type of conditions.
So imagine the same experiment I described to you before, but with one main difference. We hired an acting student, and 30 seconds into the experiment, he raised his head.
Yeah, I got all connected. What do I do?
And they say, I solved everything, what do I do next?
Sure, come up here. And
Now, this is 30 seconds into the experiment. You are still on question number 1. But there is no question in your mind that that person is cheating, and the experimenter said, you finished everything, you're free to go.
there you go. Thanks very
And you
much.
see that person taking all the amount of money and going home. What would happen to your own morality? Well, lots more people cheat. But there could be 2 explanations here. One explanation is we just prove to people that in this experiment there's no downside for cheating. The second possibility is that it's not about the fact that they wouldn't catch you, it's about the fact that it's actually socially okay.
Thank you for participating.
And so we decided to study this by looking at whether the person cheating is somebody like us, somebody we feel similar to, or somebody who's very different from us.
We ran this experiment at Carnegie Mellon. Everybody was a Carnegie Mellon student. The acting student was a Carnegie Mellon student. We dressed the acting student in the University of Pittsburgh sweatshirt. Now, what happens if you're a University of Carnegie Mellon student and a Pittsburgh student cheats? You still know that you can get away with it. Here's the proof that somebody goes home with all the money, but you don't think that people like you are doing it. And what happens now? Cheating goes down. So it's not about the probability of being caught. It's about the question of what is socially acceptable in our circle. So imagine the same experiment I described earlier. You fill in your sheets, you solve these little problems, you shred a piece of paper, and you come to the experimenter. You tell them how much money you deserve. You tell it in tokens. I solved X problems, I deserve X tokens. So now you pay them in pieces of plastic. They take this piece of plastic, walk 12 feet to the side, and change it for dollars. So when somebody looks you in the eyes and they lie, they don't lie for money, they lie for something else, but that thing becomes money very quickly. What happened? In our experiment, people doubled their cheating. Thank you. This, by the way, is the most troubling result I think we got. Think about it. In a society, we're moving away from money. Credit cards, stock options, derivatives, dealing with people over great distances.
Bitcoin.
Could it be that as these distances and all of their versions are increasing, people find it easier to misbehave and still think of themselves or ourselves as good people? And I think the answer is absolutely yes. We took all the elements that we studied and we combined them into one environment. We would get an environment that is very similar to the one that operated in the financial crisis of 2008.
Not in generations has Wall Street absorbed the number of body blows it took today.
3 of the 5 biggest investment banks are gone. The country's biggest mortgage lender is gone.
We had politicians, bankers, regulators, and even investors, all influenced by many factors. Self-deception, social norms, distance from money, lying for the benefits of others, and of course conflicts of interest. And this is what I think corruption is all about. It's about that when you get into a system and something in the system tells you that things are wrong there, all of a sudden you abandon your own moral fiber. And because of that, we really need to figure out what can we do about it? How can we get people to behave better? Because if we don't, we're just going to get more and more disasters like the one we've just experienced.
Many of the experiments that we have conducted are about trying to find ways to curb dishonesty.
We went to UCLA and we asked about 500 undergrads to try and recall the 10 Commandments. How many of them do you think recalled all 10 Commandments? 0, that's right. By the way, they invented lots of interesting ones. What happened after people tried to recall the 10 Commandments, even if they were unsuccessful? Nobody cheated. It wasn't as if the people who remembered more commandments, the people who are presumably more religious, cheated less, and the people who remembered almost none of them cheated more. Nobody cheated.
It didn't matter what religion the participants had. You know what the Ten Commandments are about. They are about the moral code, they are about proper behavior, and just knowing that and being reminded of that decreases dishonesty.
In fact, even when we take self-declared atheists and ask them to swear in the Bible, they stop cheating. It is not about heaven and hell and being caught. It's about reminding ourselves about our own moral fiber. We found this result to be very promising, but we wanted to test it in a non-religious context. So we went to MIT, and we did a similar experiment with honor codes. So we got students at MIT to sign the honor code. I understand that this short study falls under the MIT honor code. They did it, shredded a piece of paper. What happened? No cheating whatsoever. And no cheating whatsoever despite the fact that MIT doesn't have an honor code. Then we replicated the experiment at Princeton. Princeton has a very strong honor code. In fact, the freshmen get a whole week of crash course on morality, lectures, discussion. So we took the Princeton students signing the honor code and not signing the honor code, the MIT students signing the honor code and not. Was there any difference? No. When they did not sign the honor code, they both cheated to the same level. When they signed the honor code, none of them cheated. I think this is kind of a mixture of good news and bad news. The bad news is the crash course on morality, particularly the Princeton version, doesn't seem to have any effect 2 weeks down the road. The good news is that even without a crash course, reminding people about their own moral fiber does change how people behave.
Hey guys, I hope you enjoyed that video. The documentary is really, really great. That was me just grabbing pieces from the documentary. And it's just there to remind you, and I really like the part about the tokens. The further you are from actually taking money from people, the more it feels like it's socially okay, and the more it feels kind of honest. So that's why I wanted to put this presentation together, just for people to be aware of what happens when you are, buying into the hype and the FOMO of a lot of these new projects that you may not necessarily understand. So just be very, very careful. Do a lot of your own research, not YouTube research, actual research, before you start investing in a lot of projects. All right, guys, that's pretty much it for me. Let me just get to my final slide, which is just my information. And I have lots of other presentations, mostly having to do with economics and the price of Bitcoin and the history of Bitcoin and why Bitcoin is actually important and decentralized. So hopefully you can check those out. Find me on YouTube. And if there's time for questions, I'm happy to take a question or two. We got some over there on the right.
Where are we at?
Maybe you guys can come up.
Yeah. Come up to the stage, please. Makes it much easier, get a little intimate.
Hey, Tone, how you going, man?
Hey,
love the video, awesome.
Thank you.
So, do you think because I feel that ICOs are part of the crypto ethos in a way, because the notion of tokenizing things is there, right? Do you think there's any possibility that that there are legitimate projects that do ICO, that use it for the marketing purpose, that afterwards these people are invested in it and go out there and make a good company?
Sure. So there's two things to an ICO, right? There is the fundraising side to the ICO, and then there is the functionality side to the token itself, right? And this is where a big conflict comes in. Some people openly just say, hey, I am doing a token, I am doing an ICO because I need money to fund my project. Seems like an honest statement, and it's usually legitimate. What happens in that case, when, and very few projects want to openly admit that because it could put them under security laws. But here's where a problem comes in. If you openly say, I'm doing a token, I'm doing an ICO for fundraising, if you openly say that, you can easily admit, yeah, my project doesn't actually need a token to function. Other companies say, hey, we're not really tokenizing because we need the revenue, very few of these, right? So that's one honest way of doing it, right? Then you have the opposite situation. Hey, we don't really need this money. We actually have a token because we found a use case, and that's very rare. I've only seen 2 of those instances where you could have easily got the money without the token, but the token is there for functionality. What happens most often is people are saying that the token is actually needed in the project, and they're saying, no, we're not doing it for raising capital, we're doing it because our token is actually needed. And that creates a big problem, I believe, in most ICOs, because first of all, you are doing it because you need the money, and that creates a regulatory issue if you don't admit it. And in order for you to mask the fact that you're doing it to get the money by creating this token, the token is probably not needed. So your business, your underlying project, could be at risk of competition from someone that can do something a lot more efficient without a token. But there are a few. Most of the ones that I like in the ICO space are tokens that are using the functionality of the transfer mechanism of the blockchain, anonymous value routing, but they didn't need the token for the fundraising model. I think you have to be a little careful with the fundraising side of the equation, because there have always been laws and regulations on soliciting money from the general public, and I just don't see how those laws no longer apply just because the technology is a little bit better.
Good stuff. One more question at all? All right. Take it easy. We'll get to you.
Yeah, Tom, you think that these ICOs are going to worthless and Bitcoin's going to go back to 90% more dominance? How are we going to get there? How is... because what's the model of Bitcoin going back to 90% in these ICOs going down?
Well, we'll see. We'll see how the bear market ends. I still think everything is going to be going down for a while, including Bitcoin. I think that all of these ICOs, they're just going to become regulated equities, right? Like eventually the regulation is going to catch up. All of these ICOs are centralized companies. They have CEOs. They have people in charge. I mean, look what's happening with Shapeshift right now, right? They were just like, oh, we're going to be anonymous, and here comes KYC, right? Because why? Because you have a company, you have a CEO, you have a business. And when you have a business, regulation is going to come. Everyone always says, oh, we can regulate ourselves, and then everyone is complaining about manipulation in the price of Bitcoin and cryptos, right? So the regulation is coming, and all of these centralized companies are going to go back to what they are, just companies. So these ICO, and my other issue with it is, I don't think Ethereum as a technology is sustainable. So if you do have an ICO on top of Ethereum, I really hope you have, you're backing up your own data. At least run your own Ethereum node if that's possible. And you gotta have the history of every transaction of your own ICO. Because I think people have gotten over-dependent on the fact that they think Ethereum will be with us forever. When in reality, Ethereum is not scalable, and they don't even know how they're gonna implement the scaling solutions that they have. Look how hard Bitcoin struggled to get SegWit. And that was a no-brainer. That was an obvious scaling solution that works. Ethereum scaling solutions are all theoretical. And they would need to convert proof of work to proof of stake somehow to even attempt to get them in. So I think dependence on Ethereum is... don't put too much dependence on Ethereum. I know a lot of people want to migrate to like EOS and others, but they're going to be no different. I mean, EOS functions great when no one's using it. Let's see what happens when there's CryptoKitties on it, you know? So you gotta be careful with that. And also, remember the chart of the NASDAQ, right? People kept using the internet more and more and more, but the value took 15 years to get there, right? So I can see Bitcoin bottoming out real low altcoins and ICOs going even lower, and then on the way back up, it's going to be just mostly Bitcoin. These ICOs, you know, they'll be like penny stocks, right? There's no reason why any of these ICOs with billions of tokens are worth multiple dollars each. They're going to be worth some fractions of a penny, right? Like Ripple used to be worth, you know, 2 years ago, like 0.0003 cents. So on the way back up, it's going to be just Bitcoin going up because of its utility as an unconfiscatable, censorship-resistant value transfer. And it could take about 4 or 5 years for the total market cap to get to a new all-time high. Now, Bitcoin can go to a new all-time high next year, but the total market cap could take, you know, 5 more years. So we will see.
Hey, yeah. Osam here. So you mentioned that tokens are not needed in most of the ICOs, and I can agree on that. But ICOs basically came into the industry to give the retail investors something to hold into, because currently a lot of startups, me and a lot of retail investors, cannot get the opportunity to invest in. So if you go back to Facebook, Uber, Airbnb, none of us actually were able to get a bite of that.
Sure you did. I mentioned it. Facebook, IPO, $20.
You entered. I didn't. I have never heard about it, and I have never had the opportunity to buy it.
You never heard of Facebook when it went IPO at $20 a share? You could have made 10 times your money.
Not everyone is easily able to buy into IPOs, because not everyone... If you compare buying into IPO compared to buying into an ICO, what is more easy?
Oh, of course the ICO is easier, obviously.
Oh, so there is...
That's why there's the irrational behavior in buying into ICOs.
That's why retail investors jumped on it. That's why currently there's a lot of shitcoins, because there's a lot of no products, no use for the token. The shift from the ICO market should be like this. You raise funds by issuing your token. The token should not be trading until there is a functional product. And then you can actually see if there's any user acquisition, if there's any users using the product. Then there might be any value for the token. But currently the market is, I'm issuing the token, it's trading, and the product maybe will come after 2 years. That's
sure. Then we're back to regulation, right? We're back to the regulation side of the equation.
Regulations of
right. And if you look at the recent articles, we didn't talk about it on our show yet, but I mean the SEC is already announcing they're loosening their regulation on which people can invest in traditional companies. So the world was already going there, right? There's more crowdfunding, like the Indiegogo campaigns. The traditional regulation is going in that direction as well, to give people a chance to invest at an earlier stage of the project. But again, like I mentioned with the Facebook example, just because you can get in on the ground floor, it doesn't mean that you should.
It doesn't mean that you shouldn't.
It usually does.
It's going to be successful.
It usually does. Very few people. It is like going to a casino. I do not recommend.
I would like to basically gamble on my money, but yet I want to be able to.
Right, but what happens is when a lot of people that shouldn't be investing in early stage startups, like basically, look, I was on Wall Street when the housing bubble crashed, right? I was at Bear Stearns. The whole company went down. Lehman went down, right? Goldman Sachs almost went down. AIG almost went down. The whole banking system almost collapsed. And everybody got blamed. You know, do you think Bear Stearns and Lehman wanted to destroy their companies and hundreds of thousands of people lost their jobs? Nobody wanted that. You know who nobody blamed after the dot-com bubble? Nobody blamed themselves for buying an overpriced house. Everybody blamed someone else. Everybody wanted the government to do something. Arrest everyone. But no one blamed themselves for buying an expensive house. So what happens when everyone buys into this FOMO and then everyone goes broke and everyone loses the money? Everyone's going to run to the government begging them to do something because it was somebody else's fault.
Awesome. Give it up for Toby!